Hello, everyone. Happy Wednesday. Welcome to another edition of ASKROBCO. How are you doing, James?
Yeah, good. Thanks, Rob. How about yourself?
Yeah, all good. Thank you. All good. Welcome, everyone. Hope you're all well. Hope you had a good week. Going to have a really quick, powerful, punchy update today on the key trends in the market. For those of you that haven't been on the show before, we're here for banks, lending institutions, sales, credit, risk, pricing, product, all of the key areas within the property market, the lending market, valuation market. We're here to answer your questions, give you all the live intel of what's happening on the ground, what we're seeing in this very fast moving market on a weekly basis. A couple of the areas we're going to touch today. Just want to touch a bit on pricing and product. We've seen a bit of movement in the last week. Just want to share with you. We want to go into the latest sales intel and let you know what's been happening on the ground. And to let you know what we're going to be doing next week, we're going to have some really good updates on your favorite hot topics of EWS1, bit of Japanese knotweed, a bit of fire safety and cladding update on the back of the EWS1. So we're going to have some really good industry updates for you next, a bit of PI. I think that's quite prominent for quite a few of you lenders, a bit of new build, and also a bit of risk areas that we're seeing. So some really good updates coming next week, which is going to be really hot off the press, industry standard latest information for you. So whether you're going to be watching next week live or whether you're going to be watching the update on YouTube, some really key areas for lenders, for sanction, for credit, for risk in some of the key areas that you're all lending on or working in, and you're continuously asking us to provide you with either further information, intel, or updates, etc., etc. So really looking forward to that. And ahead of that next week, get those questions in where you're doing your lending on the new builds, on maybe the high rises, on the areas that have got certain issues relating to the EWS1, relating to maybe PI concerns that you've got from a lending perspective, a borrowing perspective. So ahead of next week, maybe get those questions to me or get something in writing. That would be great. Let's start as always with the latest intel of what's happened in the market over the last week. The key indicators that we're looking at is obviously sales instructions and volumes, and transactions that are going through, because ultimately that's what's driving the market, the sentiment, and in real time we understand as lenders or as sales divisions what's happening. And also, again, touching on the commercial market and the pricing and products, few new entrants back in the market this week. I want to talk about that because people and lenders are lining up for 2021. We're in the midst of lockdown 2.0. Whether we come out of that in 2 weeks or whether we go into a tier 3-2 system throughout the country, we don't know yet. But what I'm really interested in now is already the lenders in the marketplace are lining up for 2021. And I think we're going to touch a bit on that. So let's go straight into the data. For those of you that are online, it's handout 1, 34 weeks post-lockdown. I mean, 34 weeks since we went into the original lockdown is a crazy amount of time. We will be hitting week 52, not far off, to which will be 1 year, which is just incredible. And to put a bit of context on that and the sales intel and data we're going to go through now, the robustness of the UK residential market and the commercial market within, certain areas, HMOs, buy-to-lets, in the industrial market, performing and trading, logistics and distribution, and high street commercial in the sense of your retailers, especially in your Tesco's, your Sainsbury's, etc., etc. So tremendous robustness in the marketplace in a lot of areas, which has allowed for such strong lending. And it's all about pricing product in the right areas. And we're going to talk a bit more about that. So let's have a look at the data. You know the format of this. We go down to the highlighted blue line, which is week 45 of 2020. And we're going to look, as always, at the new instructions. And I see the new instructions trend now is slowing down. So remember, for 6 or 7 weeks, we were hitting 400 plus. So a lot of supply coming on stream, as it was with the great supply that we saw early in the year, pre-lockdown. And now in the last few weeks, and I think we could probably put it down to lockdown, that less properties are coming on, even though the property market is open for business. The trend on a 2-week basis now is that we're in the low 420s, which is a big drop, you know, a 20-25% drop on what we were seeing previously. And I would guesstimate that we can put that down to lockdown. And what we want to see, if the market is strong and positive, is that when the lockdown finishes, we want to see those numbers come back up a bit, because people have not been putting as many properties on the market because of the restrictions or feeling or being uncomfortable about it in the midst of lockdown 2.0. We really need to watch that key indicator. On the flip side, our sales figures, and remember, predominantly throughout the year, we've been below 100, even in the good times pre-lockdown, and the beginning of the year was explosive. The numbers were still below 200. The last 7 days again has topped 200, which is the 3rd week out of 4. So tremendously strong performance on the sales side. The pipeline is strong. The time it's taken for these sales to go through now is coming further out. We're up to about 8 to 10 weeks now. So things are really stretching, really strong pipeline. The figures are really, really strong and consistent, and we're seeing great volume on the sales side. So we expect that now to continue for another few weeks, and then it will tear off for Christmas, and then we will go into 2021. And now we can move on to a bit of pricing and product, unless James wants to add something on that.
Yeah, I just wanted to add something quickly, Rob. Sales volumes again around 200 transactions in the last week or so. So remaining positive there, good momentum. Just a quick note, HMLR, Her Majesty's Land Registry, did post some quite positive news this week just regarding their September figures, annualised positive transactional volumes, and also annualised growth for that period up to September 2020 of around 5%, which broadly mirrors some of those other sort of house price indices which we've spoken about in the last few weeks. This almost feels a bit like sort of old news with the lag that Land Registry has, though. But just to sort of speak to you about sort of those official statistics released by the Land Registry, which underline and rebuttal those facts and figures which we've brought to you over the last few weeks.
Let's go to product and pricing, and I want to build in 2021 to this, because I would say for the first time in 2020, we're seeing certain lenders and pricing and product come back into the market that have maybe been sitting on the sidelines for 6 months, quite risk averse in the sense that they're watching what's happening and being very strategic. And I'm seeing that commercial lending, challenger lending, bridging lending with certain products around high street, buy-to-let HMOs, for some of the lenders that have been out the market, they're coming back into the market, and there are a good few lenders with new products within that space. And I see that they're lining up their offering now for 2021 with soft launches at the back end of 2020 within lockdown 2.0, testing the waters. And we've been told from some key lenders that subject to getting through lockdown, getting through Christmas, there's going to be relatively aggressive lending in 2021. And I would expect the market, especially commercially speaking, to start to become more competitive. And that will then be shown in pricing and product. And with the positive news that we're seeing with the vaccine, and people will start making plans now. There's a lot of reporting, and I've said this previously, that if the vaccine goes well and it functions with a high percentage of positivity, and that kicks in within the spring, there's no reason why when we hit May, June, July, that we shouldn't have a relatively semi-normal summer. Maybe a bit like the summer we went through with a lot of people going out, but the difference might be that the retail and office markets will start to grow. And then we're looking at September, October, November next year to be a normal autumn and winter, and we won't be facing what by then could be a possible fourth wave if there was some kind of third wave in January, February. So I think if we're going to think a bit long term, the 3, 6, 9, 12 month play in the market, at the moment, the products are coming in, playing and testing the waters. And I would say the non-vanilla traditional product, because the vanilla product, the high street retail offering in the residential space, let's just say, is off the scale, record mortgage volumes of applications. It's the non-vanilla offering product and the commercial offering product that is now getting tested. And I believe we're going to see, as the year goes on next year, that market will return. Let's go into a bit of pricing. One of the things I picked up on this week that I'm fascinated by, and it's a really small detail. I saw that the nationwide, for the first time in 8 years, have returned to interest-only mortgages for very high deposit residential lending. Now, what does that mean? We know what the market was 10 years ago for all of you lending interest only. It was very aggressive, and it was very much to focus on repayments and in terms of the interest repayment and nothing else. And for products like that, I know they are in the market, but to come back with mainstream lending is a sign that the mainstream lender wants to bring in as much business as possible, and they're looking at what they would classify as riskier lending because they're not asking for capital repayments. What does that actually really mean? It means that a lot of money is going to go against the market in 2021, and that is going to be reflected in product and pricing. I'm repeating the same thing here because I want to make it clear that the market is looking so buoyant at the moment because of the government incentives, because the government is driving the economy through the property market, and the lenders are very comfortable lending a lot of money to that market at very cheap price points, as long as the covenant is good from a commercial perspective, or the income stream is good with the buy-to-let and the HMOs, or the deposits are great for the residential offering. Very cheap pricing, very good products, very aggressive as the lenders look to really kick on in 2021. James, what else you got to add on that? I think it's a real key indicator as far as I'm concerned of what we're looking forward to.
Yeah, so this week, Accord announced the return of its 90% LTV mortgages into its core range, which basically marks the return, first time it's returning since March 2020 at the start of the pandemic. So again, positive news there, sort of new products to the market. They've launched 8 product lines at 90% LTV. Just to give you a couple of figures on that, so their 2-year fixed is 3.69%. Whilst the 5-year fixed is just 3.79%, which is a very close gap between the two. And obviously, it's been forecast that interest rates are going to remain at fairly low levels for that period. And it's obviously how Accord are aligned in their thinking and their sort of product line design and their offerings. Those products are typically limited to loan sizes of 5 to 600,000, just because of the sort of risk nature of them being at 90% LTV. But an interesting product line. Barclays have also added some new sort of fairly high LTV mortgage products of up to 85%, with mortgage capital amounts from 50,000 up to £2 million. And those 2-year fixed mortgage products start at 3.22% from Barclays. So just a couple of few new products in the mortgage market there. Obviously positive news, the return to sort of higher LTV mortgage products, generally for those sort of young professionals, first-time buyers at that sort of end of the market probably.
Yeah, thanks, James, on that. I think for those in product and pricing that have a keen interest in that space, I believe the flexibility and the agility and the speed to which you react to the market in this last 6-week period, but predominantly in the first quarter of 2021, I think it's going to be key for you to be competitive and maintain your market position in the space that you're offering. So let's say that some of you are specialists in buy-to-let. To remain as that specialist lender within that space, your product and offering has to really be competitive within the market space. If you're an HMOs and that's your specialism, and you understand that a lot of competitors are coming back to the market in that space, you have to understand what their offering is, and again, be agile and flexible with your pricing and policy to ensure that you are the leader within that space. And that goes really with the mainstream lending as well. When you're in the prime, super prime, or even the development space, that we're seeing more lending now. And I think that's a key point that I didn't mention previously. I would say development went quite quiet for 6 months, and now we're seeing the specialist development lenders are suddenly looking to get comfortable with market conditions and start doing more lends. And that's just the risk curve and the volatility curve coming down, and more comfort. As we all know, the most volatile or most risk lending is always the development, because of the variables that come into play. And the biggest variable with development is time, because what's happening today and what's happening in 2 or 3 years when that product has been seen through and developed, so much can happen that it skews figures. It can skew the GDV and the ultimate pricing figures tremendously. So these are key indicators that literally within the last week or two, there's been changes, and I think that's a very key indicator of where we're going to see things move forward to in 2021. Anything else you want to add for today, James? It's been really punchy and quick, but the key points that we've discussed is really what's happening on the ground. And the one thing I would add is we saw volumes of valuations pre-lockdown 2.0 for a space of a few days drop because of the uncertainty of what the government's decision would be, because we didn't know whether the market was going to be open for business or not. And then very quickly, volumes have returned to the levels that they were the week or two before lockdown 2.0 was implemented. What does that mean? The supply chain is once again saturated, and once again there are delays in the valuations, not from us, but in the main volume valuation marketplace, the timelines are drifting out, whether it's 2 weeks, 3 weeks, or 4 weeks. Once again, the conveyancers are drifting out. They can't deal with the volume, and the mortgage processors and the lenders can't get through the volume of cases they're needing to get through. Everything's being pushed out, which is why the stamp duty window is under pressure and being lobbied to be extended to allow the volume of transactions that are taking place at the moment to get through and take advantage of that offering, just because the supply chain cannot cope with the volumes that are taking place at the moment. If you've got any challenges with that, if you need any help or assistance with that, you want to message me directly, because you are facing that challenge. I know a few of you have done previously. Please do feel free to do so, and we will do our best to advise you and guide you on how you can manage your position in that way. Very challenging at this moment in time. James.
Yeah, so thanks, Rob. So just to summarise, we've been through the sales data for this week. We've seen transaction volumes remaining resilient and robust at that sort of 200 plus per week figure. We've seen some new mortgage products launched to the market, both at sort of the more entry level and also at the higher value sector of the market. Her Majesty's Land Registry have confirmed statistics from September earlier this year were positive, with market growth across the country. In sort of property news, we've got sort of L&G of entering the build to rent market, and they've sort of quite openly stated that they're looking to make inroads into this and will be sort of aggressively entering that market. So one to sort of watch this space, a new sort of market entrance there. So that's everything from me. Thanks, Rob.
Brilliant. Thank you everyone for watching live on YouTube and for all your comments on LinkedIn and Instagram, Twitter. Amazing. Next week is going to be a really good RICS update, PI update, EWS1, fire safety and cladding update. So and some PI concerns that some of you may have. So share with your colleagues. Please put your questions forward for next week. We're going to have some really good intel for you. I want to give you some really, really high level updates and hopefully cover all of the areas of interest that you have as lenders in sales, in credit and risk, in borrowing, in the marketplace, as we see on a daily basis. Thank you all so much for joining this week. Stay safe, stay healthy, be good, and we will see you the same time next week, 1 o'clock every Wednesday, #AskRobCo. Take care, everyone.